Welcome to the Deep Dive. Now, before we get started today, just a quick but really important reminder for everyone listening. This discussion, everything we talk about, it's purely for educational purposes. We're digging into some recent economic news, but please remember this isn't investment advice in any way. Definitely speak with your own qualified financial advisor before making any investment decisions. Okay, your situation is unique. Right, with that important point covered, let's dive in. Today we're looking at a pretty major economic event that happened recently, the Reserve Bank of India's latest monetary policy announcement. We've got some great material here analyzing what went down, and our mission today is really to cut through the noise, understand what the RBI did, why they did it, and crucially, what it might mean for the Indian economy and markets.
That's absolutely right. We're going deep into the specifics of the RBI's recent decisions, and, the scale of it caught quite a few people off guard. So we'll try to unpack the logic, the thinking behind it, and what the anticipated effects are. Based on the analysis out there, it's about getting you the key takeaways.
Okay, so let's jump right in. What was the big news, the headline from the RBI this time around? What were the main actions they took?
Well, what's really striking and something that comes across clearly is the sheer scale and the sort of dual nature of the action. It wasn't just one thing. Some commentators actually called it a policy bazooka or even a double bonanza.
A double bonanza. Okay, tell me more.
So the main event, the first part, was a very sharp cut in the policy repo rate. That's the key rate, right? The one banks use for borrowing short-term funds from the RBI. It was slashed by 50 basis points. That's half a percentage point, down from 6% to 5.50%.
Wow, 50 basis points. That's more than usual, isn't it?
Exactly. It was a big surprise. Most market watchers were expecting, the standard 25 basis points. So this larger cut really sent a signal. It was also the third rate cut in a row recently, bringing that repo rate down to its lowest point in about 3 years.
Okay, 50 points is definitely a statement. And you said double bonanza, so it was the second major action.
Right. The second part, and this is arguably just as important, was a really significant cut to the cash reserve ratio, the CRR. That's the slice of deposits banks have to keep parked with the RBI, cash they can't lend out. And the CRR was cut by a full 100 basis points. So from 4% down to 3%, that's a big chunk.
A whole percentage point cut on the CRR. That seems huge. Is that immediate?
No, and that's an important detail. It's not happening all at once. The RBI planned it in a staggered way. It's rolling out in 4 equal steps, 25 basis points each time, starting in September and finishing up by November.
Okay, staggered. So that gives banks time to adjust, I suppose.
Precisely. It avoids a sudden shock to their liquidity management.
So a big rate cut plus a big phased CRR cut. That really does sound like a strong, deliberate push. What's the specific aim behind that CRR reduction? Why inject so much liquidity?
The stated goal, very clearly, is to inject durable liquidity into the banking system. Durable is the key word there. It's not just a temporary fix. This 100 BPs cut is expected to release a massive amount of funds. Estimates around 2.5 lakh crore rupees. That's 2.5 trillion rupees. A huge sum.
Wow.
And this liquidity injection does 2 main things. 1, it helps lower the bank's own cost of funds, makes it cheaper for them to operate. And 2, crucially, it's specifically designed to help speed up monetary policy transmission.
Transmission, meaning making sure the lower repo rate actually leads to lower lending rate.
Exactly. Giving banks more cash and cheaper cash is meant to push them to lower the interest rates they charge on loans for businesses and consumers faster and more effectively.
Okay, that mechanism makes sense. Lower benchmark rate, plus more fuel in the tank for lending. Now, beyond these specific cuts, did the RBI signal anything about its overall philosophy, its stance going forward?
Yes, and this is another really important point. The Monetary Policy Committee, the MPC, actually decided to change the monetary policy stance. They shifted it from accommodative to neutral.
Neutral, but they just cut rates quite aggressively. That sounds a bit contradictory.
It does seem counterintuitive at first glance, doesn't it? The rate cut and the liquidity are obviously very supportive of growth, very accommodative in practice. But changing the official stance to neutral is more about signaling the future. It suggests that having delivered this big upfront easing, they aren't committing to just keep cutting rates indefinitely. It kind of resets expectations, gives them flexibility to react to data as it comes in, rather than being locked into an easing path.
Right, okay, so it provides flexibility for the future, even after a big move now. That makes sense. So that covers what? A 50 BPS repo cut, a 100 BPS staggered CRR cut, and that shift to a neutral stance. But the big question, the one everyone listening probably has, is why? Why such bold moves, and why right now?
Yeah, that's the crucial question. And the policy rationale seems to boil down to a kind of balancing act. One major driver was the inflation outlook.
Inflation. How so?
Well, the recent data showed inflation had been moderating quite significantly. It had actually fallen below the RBI's 4% target. Retail inflation, in particular, hit a multi-year low back in April, well below what people expected. So based on this trend, the RBI actually revised its own inflation forecast downwards for the current financial year. They now expect it to average around 3.7%, which is lower than their previous 4% projection.
Okay, so inflation looked pretty comfortable, maybe even surprisingly low. What gave them that confidence?
Several factors, it seems. Easing food prices were a big part, helped by good crop prospects and hopes for a normal monsoon season. Core inflation, that's inflation without food and fuel, was also pretty stable. Plus, there were expectations that global commodity prices, like crude oil, would stay moderate. Even surveys were showing that people's own expectations about future inflation were coming down, and a weaker dollar helped reduce risks from imported inflation, too. All this together created, headroom.
Headroom. So falling and stable inflation created the opportunity to act. But what was the need? Was it about growth?
Growth was definitely the other key piece of the puzzle, yes. Now, recent GDP numbers for the last part of the previous fiscal year were actually pretty decent, better than expected, in fact, bringing the full year growth to about 6.5%. But, and this is important, the overall feeling was that growth, while, wasn't really hitting the higher trajectory the RBI would like to see, maybe something closer to 8% sustainably.
Okay, so growth was decent, but maybe not stellar, not reaching its full potential.
Right. And more importantly, the RBI saw significant downside risks to even that growth path, mostly coming from the global situation. The official statements talked a lot about concerns like ongoing geopolitical tensions, uncertainty around global trade, just general sluggishness in the world economy. These external factors, which India can't really control, were seen as potential drags on future growth here.
So global headwinds were a major concern.
A very major concern. The RBI governor specifically mentioned the need to use policy tools to boost domestic demand, both private consumption and investment, precisely to counteract these challenging global conditions. The thinking seems to be, yes, price stability is crucial, but it's not enough on its own if you want stronger growth, especially when the external environment looks shaky.
So putting it together, they saw an opportunity because inflation was low and stable, and they felt a necessity because growth needed support against these global risks. It was sort of a preemptive strike.
Precisely. That's a good way to put it. It looks like proactive accommodation. They used the space inflation gave them to front-load this significant monetary easing. The goal was to give a strong push to growth now, speed up the process of lower rates feeding into the economy, and hopefully build some resilience against those potential external shocks before they hit harder, getting ahead of the curve, essentially.
Okay, now this is where it gets really practical and interesting for everyone listening. These big actions, the rate cut, the liquidity injection, what do they actually do? What's the expected impact on the Indian market, the economy?
Right. Well, starting with the markets, the immediate reaction, as you might expect, was pretty positive. Stock markets rallied quite strongly on the announcement. Sectors that are typically sensitive to interest rates did particularly well. This kind of monetary stimulus is generally seen as good news for equity, signals easier money, potentially lower borrowing costs for companies, maybe better earnings down the line.
Makes sense. And beyond the stock market, what's the core idea for the broader economy?
The core idea is really about improving financial conditions overall and making sure that translates quickly. Cutting the repo rate lowers the benchmark cost of money. Injecting all that liquidity via the CRR cut ensures banks actually have the funds and the incentive to pass those lower costs on. So the goal is that the interest rates banks charge businesses and individuals for loans, the rates that actually matter day to day should come down faster and more significantly. Deposit rates will likely drift down too over time.
And how does that hit the ground? What's the real-world impact for, say, an individual or a typical business?
This is really where the rubber meets the road, as they say. Lower borrowing costs can be a real shot in the arm for both spending and investment. For individuals, think about loans, home loans, car loans, maybe even personal loans. Lower interest rates mean potentially lower EMIs, those equated monthly installments. Even a 0.5% cut can free up a noticeable amount of cash in a household budget each month. That improves affordability for big purchases and leaves more money for other spending, which helps boost overall consumption.
So potentially more spending power for consumers. What about businesses?
For businesses, particularly those that need loans for day-to-day operations working capital, or those planning bigger projects like building a new factory or buying equipment that's capital expenditure or CapEx. Lower interest rates directly cut their funding costs. This makes new investments look more profitable, more viable. It could encourage companies to finally pull the trigger on expansion plans. And that's seen as really important right now, trying to kickstart that private investment cycle, which has been a bit sluggish.
Okay, makes sense. What about the bond market? How did that react?
The bond market also saw a significant reaction, as you'd expect. Government bond yields, especially for shorter and medium-term bonds, fell quite a bit. That's a direct result of the lower policy rate setting a new benchmark, plus all that extra liquidity coming from the CRR cuts sloshing around in the system. The market is basically pricing in a lower-for-longer interest rate environment for now. That makes existing bonds paying higher rates more valuable, so their yields fall. And banks, flush with cash from the CRR cut, will likely be looking to park it in shorter-term bonds, pushing those yields down further.
Interesting. Now, are there any potential downsides or challenges mentioned? Maybe for banks themselves?
Yes, there's some discussion about potential near-term pressure on bank margins, specifically their net interest margins, or NIMs. The thinking is that lending rates might come down fairly quickly because of competition and the RBI's push, but banks might be slower to cut deposit rates as they want to hold on to customer funds. That gap lending rates falling faster than deposit rates can temporarily squeeze their profitability, their NIMs. However, that could be partly balanced out by gains they make on their bond portfolios, as falling yields increase the value of the bonds they already hold treasury gains. And overall, the improved liquidity and easier financial conditions are generally seen as positive for the banking sector's health, even with that potential short-term margin pressure. One group seen as clear winners, though, are the non-banking financial companies, the NBFCs. Lower interest rates significantly reduce their borrowing costs, which is a major plus for their business model.
Right, the NBFCs. So pulling all these impacts together, lower borrowing costs, more liquidity, market sentiment, which specific parts of the economy, which sectors are really expected to benefit the most from this policy boost?
You can kind of group them. You've got the sectors that are very directly sensitive to interest rates, and then those that benefit from the broader pickup in spending and investment these policies aim to create.
Okay, let's start with the directly sensitive ones.
Top of the list usually is real estate. Lower home loan EMIs make buying a house more affordable. Simple as that. This could really boost demand, especially in the affordable and mid-income segments where finance costs are a huge factor. And if construction picks up, the whole supply chain benefits: cement, steel, paints, you name it.
Makes sense. What else is very rate sensitive?
The automobile industry is another classic example. A huge number of cars and two-wheelers are bought on finance. So lower EMIs and easier loan availability can really stimulate demand. Could help both passenger vehicles and maybe even commercial vehicles if the broader economy gets a lift.
Okay, real estate and autos. What about sectors benefiting from just more money in people's pockets?
Right, that's the discretionary consumer spending angle. If people have lower loan payments, they might have more cash left over for non-essentials. So think about things like clothing, footwear, eating out at quick service restaurants, consumer electronics, maybe even jewelry. Travel and tourism could also see a boost: hotels, airlines, if people feel a bit more financially comfortable.
So a broad swath of consumer-facing industries. And on the investment side, you mentioned.
Yes, the policy is also explicitly trying to encourage investment, or CapEx. So CapEx-heavy sectors stand to benefit. These are industries that undertake big, expensive projects, often funded by debt. Think infrastructure companies, maybe chemicals, potentially manufacturing, power areas needing large investments. Lower borrowing costs make these big projects more financially viable. And any business that relies heavily on working capital loans also gets some relief.
And you mentioned the financial sector itself.
Yes, the financial sector overall benefits from easier liquidity and potentially more lending activity. But as we said, NBFCs are often highlighted as particularly strong beneficiaries because lower funding costs are so central to their business.
Got it. Okay, let's circle back quickly to that neutral stance we discussed earlier. What does that really signal about the future? Does it mean the RBI is basically done cutting rates for now?
Yeah, the shift to neutral is pretty important messaging. After delivering quite a bit of easing recently, 100 basis points in total if you count the cuts before this one, going neutral signals, they've likely done the main part of the easing cycle for now. It pulls back from an explicit bias towards more cuts. It gives them that flexibility we talked about. They're saying, okay, we've done a lot, now let's watch the data.
But does neutral mean no more cuts are possible, ever?
Not necessarily completely shut, no, but it makes further cuts less likely and highly conditional. It means the MPC will be watching incoming data very closely. Inflation prints, growth numbers. There might be room for maybe one more small cut, say 25 basis points down the line, but only if things really change. Like if growth unexpectedly falters badly, or if inflation stays well below target for a long time. Some analysts think a future cut is possible, maybe later in the year, but it really depends on things like the monsoon being normal and inflation staying very low. It's very much data dependent now.
So the focus shifts now.
Exactly. The main focus now, it seems, is less on more cuts and more on making sure the cuts already delivered actually work, ensuring that the lower rates and all that extra liquidity effectively transmit through the banks and into the real economy to actually boost consumption and investment. That's the key task now, managing liquidity, watching the transmission.
Okay, that provides a really clear picture. We've covered the big actions that surprise 50 BP's cut, the large CRR reduction, and the reasons behind them. This balancing act between comfortable inflation and needing to support growth, especially with those global worries. And we've dug into the potential impacts on markets, on borrowing costs for individuals and businesses, on bonds, and which specific sectors might feel the benefit most.
Yeah, understanding these policy moves really gives you a sense of how central banks try to stew the economy. It's always that complex interplay between domestic needs and global pressures.
So, for you listening, what's the takeaway? It's seeing how these high-level monetary policy decisions aim to ripple through the whole system, affecting everything from your loan payments to demand for cars or houses, and ultimately influencing investment and jobs. It's a powerful tool.
Absolutely. And that neutral stance tells us that while a significant boost has been given, the RBI is now in a watch-and-wait mode, ready to react but not pre-committed to further action. It all depends on how the economy performs from here.
This has been a really insightful deep dive. Lots to think about.
It certainly has, a significant policy shift to unpack.
Well, thanks for joining us to break down this important development. Keep an eye on how these things play out, and we'll be back with another deep dive soon.
Sounds good. Until next time.